The US inflation is very high at 8.6%, causing a lot of problems for lower-income families. This kind of situation has happened before in countries like Germany in the 1920s and Venezuela, where printing too much money led to disastrous results. The art of money printing, once hailed as a powerful tool shaping nations, now reveals its ominous face in the hand of the United States of America, the land of opportunity and prosperity. As the printing presses churn out currency at an alarming rate, the nation unwittingly dances with financial doom. In 2020, the U.S. printed $3 trillion, which also contributed to higher inflation worldwide. Even India's current inflation is partly because of the U.S. printing money in 2020. To understand it better, join us in this video, as we are going to explore how printing money leads to disastrous outcomes for America. Let's start with something called quantitative easing. Imagine a story to make it easier to understand. In the U.S., the Federal Reserve lends money to the Bank of America, which in turn lends money to regular people. Let's say the Federal Reserve charges the Bank of America an interest rate of 6.15%. What does the Bank of America do with that money? Well, they lend it to someone, let's say Richard, at an interest rate of 8.15% and make a 2% profit. For example, if they gave Richard a loan of $300,000 at 8.15% interest, when inflation goes up and the Federal Reserve raises the interest rate to 6.25%, the Bank of America will have to increase Richard's home loan interest rate to 8.25% to keep making a profit. This change in interest rates has a big impact on loans. Let's take an example. Richard has a home loan of $300,000 for 20 years and earns $8,000 per month. If the interest rate increases from 7% in April 2022 to 9.25% in January 2023, his monthly mortgage payment would go up from $2,326 to around $2,748. So he would have to pay more each month to repay the same loan in the same amount of time. That's an 18% increase in the EMI. Now let's think about the effect this has on Richard's savings. Suppose he typically saves around $1,500 after paying all his expenses. But with the increased EMIs, he would only have $1,078 left. Over the course of a year, this means he would have $5,064 less to spend. As you can imagine, when a family has several $1,000s less in their budget, they have to cut back on buying cars, going out, and buying luxury items. The same thing happens to millions of Americans when home loan interest rates go up. They start buying fewer cars, spending less on clothes, and cutting back on vacations. This decrease in demand for products eventually forces businesses to lower their prices so that people can afford them. For example, if a car costs $200,000, many people like Richard won't be able to buy it unless the price drops to $160,000. And even then, they would need a car loan. So, car companies like Volkswagen would have to reduce their prices to $160,000 to attract more buyers. However, Volkswagen is facing challenges because its production costs have gone up. Semiconductor shortages have made semiconductors more expensive. Gas prices have increased due to the Russia-Ukraine war. And shipping costs have also risen. The cost of making cars has gone up so much that Volkswagen can't sell them for less than $165,000. This creates a problem because buyers can't afford to pay more than $160,000, and sellers can't lower their prices below $165,000. This situation creates a stagnant market where money isn't flowing properly. This is what a recession looks like. Now, you might wonder what the Federal Reserve can do to solve this problem. This is where quantitative easing comes in. It's a method the U.S. Federal Reserve uses to lower interest rates and inject money into the economy to get things moving again. Let's delve into this intricate concept by narrating another story. But before that, it'd be really nice if you show your support for our work by subscribing to this channel and turning on the notification bell. It will motivate us to produce more amazing videos that will be useful for countless viewers. Just like in the tale where the Federal Reserve extended a loan to Bank of America. They now decide to inject $100 billion into the economy by purchasing a $100 billion bond from Bank of America. This enables Bank of America to borrow funds from the Federal Reserve at an incredibly low interest rate of only 0.1%. Following a similar pattern, just as Bank of America raised interest rates for individuals like Richard from 7% to 9.25%, they would now reduce Richard's interest rate to a mere 4%. This adjustment still allows them to make a profit of 2% while also giving them ample funds to lend to the American people. In the real world, if we observe a graph depicting the Federal Reserve's interest rates, we can see a relatively stable range of 1.5% to 2.5% until 2020. However, when the COVID-19 pandemic hit and the economy came to a halt, the Federal Reserve began printing money, causing interest rates to plummet to as low as 0.05%. Consequently, even banks reduced their interest rates. This outcome can be attributed to the injection of $3 trillion into the U.S. economy through monetary expansion. Returning to our story, as a result of the lowered interest rates, Richard's monthly home loan EMI would decrease from $2,748 to $1,818. Consequently, his monthly savings would increase by $930, amounting to a yearly increase of $11,160. This means that, similar to Richard, when millions of people experience a significant rise in their savings, their purchasing power surges, enabling them to effortlessly apply for car loans and purchase vehicles. The heightened demand for Volkswagen cars prompts the company to raise the price to $205,000. Yet people are still eager to buy. Consequently, VW further increased the price to $220,000 due to the overwhelming demand. This demonstrates how quantitative easing expands the supply of dollars within the U.S. economy, ultimately amplifying the purchasing power of individuals like Richard. As millions of people witness an increase in their purchasing power, the demand for products rises, eventually leading to an increase in the prices of goods within the U.S. Here arises the question, in this story, has the Federal Reserve's money printing caused inflation in the U.S.? Now we will explore the dark reality behind the U.S.'s monetary expansion and the unintended consequences of quantitative easing. To comprehend how quantitative easing in the U.S. triggers inflation in other countries, we will once again employ a narrative. Just as we observed in our previous example, when individuals like Richard witnessed a decrease in their home loan EMIs and began purchasing more vehicles, Volkswagen, a German company, raised the price of their cars from $200,000 to $220,000. However, simultaneously in Germany, the same car was sold for 200,000 euros. For simplicity, let's assume that €1 equals $1. Returning to our story, VW sells the same car for $220,000 in the US and for 200,000 euros in Germany, which is equivalent to $200,000. As you can see, they are forfeiting a profit margin of $20,000 per car. So what does VW do? To capitalize on better profit margins with American customers compared to German customers, they commence shipping more cars to the US, aiming to meet the escalating demand. Assuming low import duties or a free trade agreement between nations, the increased shipments of cars to the US prompt VW to elevate prices in Germany to $220,000. This indirectly presents Germans with a choice. They can either purchase the car at a higher price, or VW can ship it to the US. Consequently, US money printing augments the demand for imports, leading to elevated prices and inflation in other countries as well. The US's money printing via quantitative easing augments the purchasing power of Americans, thereby triggering an upsurge in domestic prices. Consequently, the demand for euros escalates, causing the euro to appreciate against the dollar. Although this may seem advantageous for the euro, it poses a predicament for European exporters. As the euro strengthens, the cost of their products in dollars rises, rendering them less competitive in international markets. To counter this effect, countries like Germany might need to engage in further money printing to devalue their currency and maintain competitiveness, ultimately leading to inflation. This illustrates how U.S. quantitative easing can result in currency depreciation and inflation in other nations. However, the U.S. can continue printing money without succumbing to hyperinflation as long as the U.S. dollar remains the world's reserve currency. So, what do you think now? Are we headed toward an inflationary spiral that will erode our purchasing power and destabilize our economy? What measures can we take to safeguard our financial future and protect our hard-earned wealth? Share your ideas and thoughts in the comment box below. If you found this video thought-provoking, make sure to hit the like button and subscribe to our channel for more insightful content. Don't forget to click the notification bell to stay updated with our latest videos.